Dividend income has a reputation problem. People picture retirees checking the mailbox for paper checks, or influencers promising yachts funded by monthly payouts from companies they barely understand. The truth is quieter and better. Dividends are not magic. They are simply a way for businesses to share profits with owners. If you own a slice of a company and that company earns more than it needs to grow, it can send part of those profits back to you in cash. Start small, keep buying, reinvest while you're building, and one day your portfolio feels like a modest paycheck that doesn't ask you to clock in. There's nothing flashy about it. That's the point. Real dividend income grows like ivy, slowly, persistently, and then all at once in the late years when compounding finds its rhythm. Begin with what a dividend is and what it isn't. It is not a bonus for buying a stock. It's part of your return, carved out of a company's profits and distributed to you per share, usually quarterly. The company's board of directors decides how much to pay based on profits, balance sheet strength, investment opportunities, and culture. That last word matters. Some firms treat dividends as a promise they will bend to honor. Others treat them as flexible. A dividend is never guaranteed. It can be raised, paused, cut, or eliminated, especially in recessions or when a company must protect itself. You should not chase yield the way people chase coupons. You should build a plan where dividends are one stream among several, fed by sensible investing rather than by a search for the highest number on a screen. There are two main ways beginners approach dividend income: owning a small number of hand-picked dividend-paying companies, or owning broad index funds that include thousands of companies, many of which pay dividends. The first route feels more personal and can work if you enjoy research and accept concentration risk. The second route is boring and effective. Buy a low-cost total market index fund or a dividend-focused index fund and let the underlying companies handle the paying. A blended approach is common, a core of broad index funds for stability and diversification, with a satellite of a dozen or fewer individual dividend stocks you understand and intend to hold for a long time. The starting line is tiny. You do not need a lot of money to begin. You need a habit. Open a brokerage account or use your retirement accounts if available to you. Turn on dividend reinvestment, DRIP, so that every dividend received automatically buys more shares of the same fund or stock without you doing anything. Set an automatic monthly purchase, even $25 or $50 matters at the beginning, into your chosen fund. The DRIP builds a feedback loop. Shares produce dividends, dividends buy more shares produce larger dividends. For a while, the numbers look silly. Then one year, they don't. That transition is compounding's favorite party trick. Yield is the first number beginners fixate on. It is the annual dividend per share divided by the current share price expressed as a percentage. If a stock trading at $100 pays $4 in annual dividends, the yield is 4%. This number moves as prices move. It does not measure safety or growth. A very high yield can be a warning flag. If a stock price falls because investors worry about the business, the yield goes up mechanically, even as the risk rises. A lower, steady yield from a durable company that grows its dividend consistently often outperforms a flashy yield that's about to be cut. Dividend growth, the rate at which a company increases its payout over time, is the quiet engine behind rising income. A 2.5% yield that grows 8% per year can beat a 5% yield that never grows. The long game loves growers. Payout ratio is the second number worth knowing. It measures what fraction of earnings are paid out as dividends. A firm paying out 40 to 60% of profits leaves room to reinvest and to keep paying during lean times. A company paying out 90 to 100% of earnings is promising more than it can likely sustain if profits wobble. Cash flow matters too. Some businesses have seasonal or lumpy earnings, but steady free cash flow. The safer dividends come from companies with modest payout ratios, durable cash flows, and conservative balance sheets. You do not need to become an accountant. you need to learn enough to avoid obvious traps. Businesses in structural decline that are using dividends as perfume, firms that borrow to pay shareholders, and serial diluters who issue shares faster than they mint profits. Taxes are the part of dividend investing that either bite or behave depending on where you hold your assets and what kind of dividend you receive. In many countries, qualified dividends from eligible companies receive favorable tax treatment compared to ordinary income. Non-qualified dividends from some REITs, bond funds, or foreign firms, depending on structure, may be taxed at ordinary rates. Tax rules differ by jurisdiction and change over time, so the beginner's rule is simple. Prioritize dividend strategies inside tax-advantaged accounts when possible, retirement accounts, tax-deferred, or tax-free vehicles, so reinvestment compounds without annual friction. In taxable accounts, consider total market or dividend index funds with low turnover for efficiency and keep meticulous records. The goal is to reduce the drag that taxes place on compounding while staying within the rules that apply to you. Dividends are not a substitute for diversification. A well-built dividend plan still spreads money across sectors: consumer staples, healthcare, industrials, technology, financials, utilities, energy, real estate, and across geographies if that suits your life. Concentration in one high-yield sector, for instance, chasing only utilities or only pipelines, can turn a portfolio into a single-story building on a floodplain. Income should come from many places, so that when one river runs low, others keep flowing. The simplest diversification tool remains broad, low-cost funds. If you add individual names, do it slowly, with a limited share of the portfolio and with a willingness to hold them through rough quarters, as long as the business case remains intact. Reinvestment is the quiet superpower. When you're building wealth, reinvest every dividend unless you have a precise reason not to. Reinvestment avoids the mistake of letting cash sit idle or drift into new positions without a plan. It also trains your brain to think in shares rather than in dollars. As the number of shares climbs, the dividend stream climbs with it, automatically, without your week needing to get louder. Don't overcomplicate it. Automate the reinvestment. Automate your monthly buys and focus on earning more, saving more, and letting time pass. The habit of not touching the machine you've built is as valuable as the machine itself. When the portfolio is small, dividends feel symbolic. A few dollars arrive and you shrug. Do not despise small beginnings. Track your annual dividend income in a simple note or spreadsheet. Each quarter, log what your holdings paid. Watch the line creep up. Early on, the increase comes mostly from new contributions and reinvestments. Later, growth in the payouts themselves dominates. This is where dividend investing gets emotional in the best way. The income stream starts to feel independent of your effort. It's not, you built it, but it arrives whether you're paying attention or not, because businesses around the world are working on your behalf. A common beginner mistake is to build a dividend trap portfolio, high yields from shaky firms, because the income number looks impressive on day one. That income is fragile. Ask different questions. Does the company have a durable advantage or a commodity product that swings with prices? Does it depend on a single customer or one regulation? Does it compete on price alone? Can it raise prices without losing customers? Does it carry debt that could become a problem when rates rise or credit tightens? Has management raised the dividend thoughtfully for many years, or did it jump recently to lure investors? Boring businesses that sell necessary, repeat purchase goods and services often make the best payers. Boring is beautiful when checks are involved. If the joy of picking individual stocks doesn't appeal to you, a dividend index fund or an ETF designed for dividend growth is a simple, powerful core. It owns hundreds of companies screened for quality and payout histories, rebalances automatically, and pays you on a schedule. Your job becomes behavioral. Add monthly, ignore headlines, and let the distributions drip back in. The choice between a broad total market fund, which includes both payers and non-payers, and a dividend tilted fund comes down to taste and goals.
Total market funds can produce strong long-term returns with a lower headline yield. Dividend funds produce more visible cash flow. Many investors blend them: total market for growth and diversification, dividend growth for a rising cash stream, and perhaps a modest allocation to REITs if they desire real estate income and can handle the volatility and tax differences. There's no perfect mix, there is a consistent one you will keep. Dividends have cycles, just like everything else. In recessions, companies cut. Not all, but enough that your income dips if you own individual names. This is not failure, it is the system breathing. The antidote is margin of safety, companies with conservative payout ratios and strong balance sheets, diversification, relying on many payers rather than a few, and personal flexibility. Your budget can absorb a temporary dip because your emergency fund exists.
The phrase living off dividends carries romance, but in practice, most people benefit from a blended withdrawal strategy when they finally want the income. Dividends, interest, and some strategic share sales combine to create cash flow in a tax-efficient way. Selling shares is not a sin, it is simply converting built-up value into spendable cash. In fact, a rigid rule to never sell, use dividends only, can lead to bad asset allocation and excessive concentration just to keep the income number high. When you begin taking income, turn off DRIP where needed and direct payouts to your cash bucket. Maintain a few months of expenses in cash-like instruments. Refill from dividends, bond interest, and occasional rebalancing sales from positions that have grown beyond their target. Keep it on a calendar. Retirement succeeds when your plan is boring enough to run while you're doing something more interesting than staring at screens. Real-world dividend income grows through 4 levers, pulled slowly. First, contributions. The more you add early, the more power time has. Second, yield. Modest, sustainable yields from quality companies set your starting flow. Third, growth. Dividend increases year after year produce a rising stream without you doing anything. Fourth, reinvestment. Using income to buy more shares until you need the cash makes the line steeper. A fifth defensive lever exists too: cost. Lower expense ratios and fewer frictional taxes keep more of each dividend in your pocket. You cannot control markets. You can control levers 2 through 5 by choosing what vehicles you buy, where you hold them, and how you behave. Timeline expectations matter. Dividend income is slow at the beginning, even with consistent contributions. That is okay. If you can set a modest monthly goal, I want my portfolio to pay me $50 per month within a year, $100 within 2 to 3 years, you create milestones that keep you motivated. Celebrate progress without dismantling the machine. When you hit $50 per month, buy a book and a coffee with 1 month's payout if you want the tangible reminder, then keep reinvesting the rest. As the stream grows into the hundreds per month, you can either let it pool as part of your growing emergency and opportunity fund, or later choose one small bill it pays automatically. The moment a portfolio quietly pays a utility bill each month is when the project feels real. It is also when you should guard your habits more fiercely, because success invites tinkering. Resist the urge to rearrange what is working. Beware of yield traps in sectors you don't understand. Real estate investment trusts, REITs, master limited partnerships, MLPs, business development companies, BDCs, and high-yield bond funds all dangle attractive payouts. Some are excellent, others are complex, sensitive to rates, and taxed differently. Learn the rules before you buy. Distribution coverage, leverage, exposure to single tenants or borrowers, sensitivity to refinancing waves, and how payouts are classified for tax purposes. If you don't have the appetite to learn, it is better to accept a lower, safer yield from a broad fund than to wander into a thicket chasing a number. Dividend investing is supposed to lower your blood pressure, not raise it. International dividends diversify your income but add wrinkles. Foreign companies often pay on different schedules, semi-annually or annually, and foreign withholding taxes may reduce the payout in taxable accounts, though credits often exist to offset some of this. Currency moves affect the value of your dividends when converted to your home currency.
Global dividend funds handle the paperwork and distribute in your currency, smoothing queasy stomachs. If you buy individual international pairs, read about withholding, tax treaties, and how the company reports in your market. Complexity is not always worth it. Simplicity lets you keep saving and living. Brokerage features can help beginners stay organized. Many platforms allow you to create goals or buckets: dividend income, house down payment, education. Even if your dollars are fungible, naming them can keep you invested through boring months. Turn on automatic dividend reinvestment for your accumulation phase, and consider turning it off selectively later. Use fractional shares to keep all cash working if your broker supports it. Dividends of $3.42 can buy $3.42 worth of your fund instantly. Set up email or app alerts for dividend announcements if you hold individual names. It keeps you informed without doom scrolling. Keep statements, 1099s, and confirmations in a folder that future you will thank you for when taxes roll around. The best part of dividend investing for beginners is that it doesn't ask you to predict. You don't need to guess next quarter's inflation print, time a recession, or anticipate a merger. You need to pick sensible vehicles, automate contributions, reinvest, keep costs low, and go do your work and your life. The portfolio appreciates in the background, and the income stream thickens. You return to the account on a schedule, monthly for contributions, quarterly to log dividends, annually to rebalance, and otherwise you forget. If something truly changes in a company you own, you decide with calm criteria whether the thesis broke. If it didn't, you hold. Patience is the scarcest asset in the market and the cheapest one to acquire if you build systems that don't depend on daily motivation. If you're starting today with nothing, your first step is a small automatic buy into a broad, low-cost fund and turning on DRIP. Your second step is a 30-minute education. Read the definitions of yield, payout ratio, qualified versus ordinary dividends, and expense ratio. Your third step is to pick a simple target: $100 a month in dividends within 3 years, backed by a monthly contribution you can actually sustain. Your fourth step is to stop staring at quotes. Let your time and your habit do the lifting. If the market falls, your reinvested dividends buy more shares at lower prices. If it rises, your holdings are more valuable. In both cases, your stream is growing if you keep adding. You are not dodging rain, you are filling a cistern. Years from now, the quiet, boring habit you built will feel like an extra coworker, one that deposits funds into your life without meetings or emails. That coworker won't care if you had a tough week, and it won't ask for a raise. It will simply pay because you own small parts of hundreds or thousands of enterprises that serve millions of people every day. That is what dividend income really is: the world paying you for being useful by proxy. Start small, grow quietly, and remember that you are not trying to win a game on the internet. You are trying to build a week that costs less because some of it is already paid for by yesterday's discipline. When the transfer hits, smile once, then make dinner. The IV is doing its work.